We've just seen one of the biggest volatility shocks in the history of the VIX, the volatility index of the S&P 500. And with it, we're starting to see US stock markets crashing. We're in the process of seeing that, and what I want to do in today's video is I want to achieve two things. I want to first of all talk about why this is happening and go through the catalyst, because once we identify the catalyst, we can go back in the past and we can see what the outcome was in prior circumstances similar to this. And the second thing, and the more important thing, is I want to show you what is most likely coming next based on similar catalysts that we've seen before in the past. And in this video, I also want to show you exactly where in the S&P 500 I think the bottom is likely to come once this crash is finished. So what's actually gone on here? Well, Japan's Nikkei has seen the biggest rout since the 1987 Black Monday. So what we're looking at here is a Black Monday 2.0 for the Japanese stock market. Japanese stocks have collapsed on Monday in their biggest single day rout since the 1987 Black Monday sell-offs, driven by last week's plunge in global stock markets, economic concerns and worries investments funded by a cheap yen were being unwound. The Nikkei share average shed a staggering 12.4%. So when Reuters talks about investments funded by a cheap yen being unwound, what exactly are they talking about? They're talking about the yen carry trade, what's known as the yen carry trade, because it's quite a famous trade, and this is the catalyst which has caused the sell-off, first of all in the Nikkei, and that is what is having a knock-on effect into US stock markets. And we're going to look in this video about what's happened in US stock markets in the past when we've seen similar catalysts to this. So what's the yen carry trade? So a carry trade, very simply put, is the selling of a lower yielding asset and the buying of a higher yielding asset. So in this case, the yen is a perfect candidate because the yen has been subject to negative interest rates. While the rest of the world has seen positive interest rates, Japan has seen negative interest rates. So the Japanese yen has been a favorite for a short as part of a carry trade, right? You can have carry trades between any currencies with interest rate differentials, but because of the negative interest rates in Japan, that has been the number one candidate to short, and traders have been shorting the yen versus the dollar, versus the Aussie, versus the New Zealand, etc. Now, what happens is when you short a low interest yielding currency like the yen with negative rates, and you buy, let's say in this case, the US dollar with 5.5% rates, you're making money on the spread. However, you make and lose nothing on the trade itself if the asset doesn't go anywhere. If, on the other hand, the asset starts to rise, in this case, US dollar versus the yen, not only do you make money on the spread, but you also make money on the underlying pair. So all the time the US dollar yen is going up, and the carry traders are adding to their positions by shorting the yen and buying the dollar so they can collect the 5.5% interest rate in the US, and at the same time they're selling the negative interest rates, and the US dollar yen is moving up in their favor, then they're making money. The problem comes when the currency pair starts to turn the other way. Then the carry traders, yes, they're making money on the spread, but they can start to lose money on the actual position. And what we've seen here is we've seen the weakening of the yen. We've seen the carry trade getting bigger and bigger as people have been shorting the yen to buy other currencies with higher interest rates to make money on the spread. And at the same time, the yen is weakening versus those currencies, so they're making money on the trade. But what happened in July was not only did we start to see a reversal in the carry trade itself, in other words, US dollar yen reversing, the BOJ came out with a surprise rate hike, and this catalyzed the unwinding of the Japanese yen carry trade. And this has resulted in a nearly 20% sell-off in the Nikkei in just a few days. And the Bank of Japan are under fire for doing this because they've exacerbated the unwinding of the carry trade, which was already in place. And they're now under fire for what's been seen as quite poor timing of that surprise hike. So let's now move on to the US stocks, and now we've got that catalyst which has caused the sell-off in US stocks, the unwinding of the yen carry trade, which has put not just downward pressure on the Nikkei and caused a crash in the Nikkei, but also caused outflows of US assets as well, and this has been the reason, the catalyst for the sell-off in the US stock markets. So what I want to do now is go back and have a look at prior examples where we've seen external shocks based on currency crisis or a crisis in another country having knock-on effects into the US, not just so we can see what's happening now, but also we can anticipate what's most likely going to come next in the US stock market. So let's have a look at the VIX, the volatility index of the S&P 500 in the US, and look at that massive volatility spike on the right-hand side, dwarfing virtually all other volatility spikes apart from the COVID crash and the great financial crisis, but dwarfing all the rest of them going back to 1990 here in this data set. And you can see that any time volatility in the S&P 500 gets above 45, we basically have some kind of event and a crash in the US stock market. And when you go back through the catalysts since 1990 for such a volatility spike above 45% and a crash in US stocks, you can see that there are a couple here that really stand out, one in particular that I want to look at in terms of its similarities to what we're seeing currently with US stock markets and also what's happening in Japan. So on the left-hand side, we have the Russia default crisis, and this alongside with the China Black Monday event in 2015, these are two of the volatility spikes we can pick out of this data set that are similar in the sense that they are external shocks from, say, Russia and then from China, which also resulted in currency shocks. So in both of those situations, the currency was devalued. In this situation, of course, the yen is actually appreciating in price. But what we're seeing in both the Russian debt default crisis and the China Black Monday event in 2015 is an external shock, especially in the China Black Monday 2015 event, which then has knock-on effects to the US. Unlike the dot-com bubble, which was, US recession-based, the great financial crash, US recession-based, US flash crash, US credit downgrade, even the crypto crash and the Fed tightening of 50 basis points. The COVID crash, of course, was, shutting down the global economy, but also the US economy. So out of these, really, we can look at the Russian debt default crisis and the China Black Monday crisis and assess the knock-on effects that had at the time when we got that volatility spike of over 45% and what those external shocks did to the US stock markets. So now we've identified those two prior external shocks since 1990. Let's go back and have a look at the S&P 500 itself and see what happened at the time when we got those external shocks and those knock-on effects onto the S&P 500. So if you go back and have a look at the history of the S&P and look at the Russian debt default crisis, you can see we have about 7 down weeks pretty sharply, followed by a 3-week bounce, and then we get this kind of second attempt to take out the lows, and then we reverse and we start the next leg up. And what's noticeable about this is that not only was it sharp, but it was also shallow. The overall correction in the S&P 500 was only about 22.45%. Now compare this to some of the other shocks, such as the great financial crisis or the dot-com bubble, where we see over 50% corrections. And you start to see that when you get these knock-on effects from other countries onto the US stock market, you tend to see more shallow corrections because the fundamental reasons for the sell-off are not quite there. And actually, what you're seeing is market mechanics where you're getting forced liquidation and this kind of thing, which is not necessarily attached to the fundamentals. In fact, it's very often detached from the fundamentals of the US economy if you're getting that outside exogenous shock from another country, such as Russia in this case. So what we saw there during the Russian debt default crisis and that big VIX spike at the time was a knock-on effect to US stock markets, but because the fundamental problem wasn't in the US itself, it was exogenous, it wasn't endogenous, it means that the correction was more shorts being liquidated, margin calls, and it quickly recovered after just a 22-23% more kind of shallow and sharp correction. So let's have a look now at the 2015 China Black Monday event, which caused that VIX spike above 45 as well. So in August 2015, the Nikkei index declined almost 12%, with a near 9% dive posted on a single day. And this was because of slowdown in China and a Chinese yuan devaluation. So what I like about this example is that we have this kind of exogenous shock from Asia, and we also see a big impact in the Nikkei itself, down almost 12% of the time. Now, we just looked, the Nikkei is down nearly 20% this time, but that shouldn't be a surprise because the shock itself came from Japan, whereas the shock in 2015 came from China. What's also very analogous about the 2015 shock out of China is that on August 18, 2015, the Dow Jones Industrial Average fell 33 points. On August 19, 2015, it lost 0.93%. And on August 20th, it lost 2.06%. A steep sell-off then occurred on August 21st when the Dow Jones fell 531 points or 3.12%, bringing the 3-day loss to 1,300 points. The 8% drop in China on August 24th was termed Black Monday by the Chinese state media. Now, what's interesting, if you add up the 0.93%, 2.06%, and the 3.12%, you get a percentage decline in the Dow Jones over 3 days of 6.11%. When we had that VIX spike above 45 on the China Black Monday event in 2015. Now, if we're going to have a look at the Dow Jones right now, you can see we also had a decline over the last 3 days, very similar to that shock the Dow Jones got from the 2015 China Black Monday event. And the sell-off is also very similar. Instead of 6.11, we're currently at 6.32 over the last 3 days with that 3-day decline. So the current exogenous shock out of Japan is not just very similar to the 2015 China Black Monday event in terms of being a similar catalyst. It's also very similar in the impact that it's actually had on the US stock market and the Dow Jones here in particular. So if we go and have a look at the China Black Monday sell-off in the S&P 500, you can see we got that kind of 10-12% down initially, followed by roughly a 10% kind of bear market rally. And then we got the final secondary sell-off, very similar to what we saw in the Russian default crisis. We had that kind of 7 weeks down, then a bounce, then an attempt to take out the low, and then we rallied. And we end up with just a shallow 15.21% correction. Again, why? Because the shock is exogenous to the US market, and therefore it's not necessarily attached to the fundamentals. So we didn't see, in that circumstance, a 50% plus decline like we did in 01 or 08. So there are more examples throughout history of those volatility shocks, but for brevity, I've just looked at the prior two exogenous shocks, the 2015 China shock, and then before that, the Russian debt default crisis. And you can see in both of those cases, because it's an exogenous shock and it's not endogenous, you're not looking at the US fundamentals with the US in recession, you can see that the corrections tend to be shallow and they tend to be driven by not the fundamentals, but by liquidity, margin calls, repositioning, etc. So what I want to do now is I want to go and have a look at the S&P 500 and show you a very interesting setup based on what we've just discussed and why I think we could probably pinpoint a very good potential area for a bottom after this correction finishes. So if we have a quick look at the Japan Black Monday 2.0, which is exactly where we are now in the S&P, we've got that initial kind of sharp sell-off over the last few days. We just looked at the analogy of the Dow Jones, which has had almost exactly the same sell-off as the 2015 China Black Monday. And what's very interesting about this setup in the S&P is if we get, as we have seen before with the US, a more shallow correction, 15 to 20% roughly, based on the fact we're seeing an exogenous shock to the US stock market. This is not endogenous, it's not a US recession. And there's a caveat here, of course, if the US does go into a recession, then you could see a bigger correction. But assuming the US continues to kick any kind of recession into the long grass, then it does look like we are on track for a more shallow correction. And a 15% correction takes us right back to the prior major highs. So we've got this breakout, we've got this kind of reversal, this setup, what's known as a stair step. When you break a prior high, you come back, you retest it, and very often that is a technical bottom for the next leg up. So not only do we have the history of exogenous shocks causing 15 to 20% corrections, when we overlay that historical kind of data onto the chart, we can see that takes us right back into a technical support area, which is very, very interesting. Now, if we jump to the monthly chart here, just the same thing, you can see this is the prior monthly high. And if we take the prior monthly leg, which is the last momentum leg up in the monthly chart, you can see that that prior high also sits right at 50% of the prior monthly leg up. So now you have a confluence of two quite solid technical setups overlaid onto that historical precedent of exogenous shocks causing roughly a 15 to 20% correction. So if you just go back to the weekly chart here, and you can see I still have the prior high highlighted at 15.01 from the peak, and also the 50% retracement of that prior monthly impulse wave to the upside. When you put all of this together and you take what we've looked at in the 2015 example with the China Black Monday and then the Russian debt default crisis, if we are set for a shallow correction, I would expect most likely we're probably looking at that 4,420 area. So right into the prior high, we probably dip a little bit below it. I wouldn't be totally surprised if we came down to 4,750 roughly. Just as a general area or zone, I would highlight the 4,750 to 4,850 area. Now, how I anticipate this to develop, and you can see we're already making a recovery or an attempt at a recovery, is just like in the prior two examples, we get that initial sell-off, we get an attempt, and the initial sell-off, maybe 10 to 12%. We get an attempt at a recovery, and then we get a second leg down, which takes out the prior low, and then in this case, into the prior major monthly high, 50% retracement of the monthly leg. And that second attempt to go down is what I would highlight that we should all be looking out for in terms of a potential reversal to the upside and the bottom near term in the S&P 500. So the final caveat here is, of course, this is if the US does not go into a major recession. If we do get the US going into a recession, we could very well see a deeper correction. However, we have the data just out of the US ISM services, the largest sector in the US now going back into growth territory, services PMI 51.4. New orders is also from contracting to growing. We also have employment jumping into growth territory, and prices, the inflation component of that survey, has actually increased. If we're getting more inflation and more growth, then we are actually going to see some resilience in the US economy. And again, this is one of the reasons why I think we're probably going to see a more shallow correction in the near term in the S&P 500. We've also just had the Atlanta Fed GDP Now data out, and they've increased their forecast for Q3 up to 2.9% growth from 2.5%, which was out on August 1st. So I'm not saying that there's not going to be a US recession, but I am saying if it's a shallow recession, or if the US manages to kick it into the long grass into 2025, then there's every chance, based on the price action from historical exogenous shocks, that we end up with a shallow 15 to 20% correction right into that prior high, that monthly broken resistance, potentially turning support. So that really nice technical setup aligning with that exogenous shock 15 to 20% correction. And that 4,750 to 4,850 area really being one to watch, in my opinion, for a potential end of this correction and the next leg up. And it may even be to new highs, and perhaps there's a US recession next year. But for the meantime, if there's no US recession, keep an eye on that 4,750 to 4,850 zone. So that is it from me for today, guys. As always, I hope you enjoyed today's video. And if you did, why not consider joining us in the GMT training room each day, where I look at the best markets, as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge Hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge Hedge- platform is included with every GMT membership.